You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome to the podcast today. Today, I wanted to talk about one of my favorite topics, or maybe it's my least favorite. I'm not really sure, but it's something that definitely fires me up. And that is the topic of whole life insurance and Dave Ramsey. Dave Ramsey. Oh my goodness. Now, I don't think everything he says is bad or useless or not helpful. I think he has some good things. I think he means well. I think that he has a stance. Definitely has a negative stance on whole life insurance, and he has his reasons, but I'm here to bust up some of those reasons today and help you understand why actually it is a great thing and not a terrible thing, as Dave Ramsey would say. Just to start off on a positive note, I would say that some of the positive things that he teaches are maybe how to budget, maybe just the advice he gives to get on a budget. The whole live below your means, don't be overspending. Of course, that's going to be helpful, useful information. He does also like to teach about the debt snowballing your debt, paying it off and getting rid of it, and then living below your means. Yes, all good advice, very good advice. And for those who maybe never in their lives had an opportunity to talk to someone, maybe like me or an IBC practitioner or someone who has a more in-depth perspective of how you could use whole life as an asset class in your portfolio. For someone who has no access to that, then I would say the information he gives, sure, you should definitely have some life insurance. And if you can't afford whole life, or if it's just out of your range, certainly you should have term life. Term life is great for a lot of things, at least to make sure your family is protected for a term period of time. But Dave, what does he hate? He hates whole life insurance. And he lumps in variable or universal life insurance with that as well. That includes universal life, index universal life, which is highly popular right now, and variable universal life. So he kind of lumps all those together and he calls it permanent life, when really the only truly permanent life insurance is whole life. That is the only contract that is guaranteed to pay out a death claim to age 121 or 120, or maybe even 100 with some companies. But to age 121, it's guaranteed to pay a death claim. It has cash value that's guaranteed to grow. Certainly, the older you are, it's maybe not going to grow as much as you would like, or not grow very much. Or if you're in your 80s, maybe not grow at all, but it's still going to accumulate cash value for you that you do have access to and can control and can use in your lifetime, as well as having that guaranteed death benefit. Whereas universal life, sure, it's meant to be permanent and it can be permanent. It might outlive most people, outlive some people. I don't know if it would outlive most people, but people like to look at it like it is a permanent product, when really, because of the risk, because of the possibility of the insurance company to increase the charges on your current age, increase it as you age, then actually increasing because you're aging, and they can also increase the cost per unit. It has nothing to do with age necessarily. Because of that, it's a risk that the policy could lapse, or that you're going to have to fund it with more premium than you're currently funding. They might send you a notice that says, hey, you actually have to increase your premium to this amount, or you're going to lose your policy altogether. So because of that, I don't consider it true permanent whole life insurance, because it may not be. It may end up lapsing. It may end up eating itself away if the costs go up too high and you don't have enough cash value in your policy. Okay, now let's take a look at one of Dave Ramsey's claims. His claims against whole life insurance. He will say that there is no cash value available in the first 3 years of a policy. You have no cash available. That's one of his standpoints on why it's so terrible, and that is outright false. And it's not just my opinion that it's false. It is false. It's not a fact. It is not right. So the type of policy that he's talking about in this example, where he says there's no cash available, is maybe the traditional way people would build a life insurance policy when it is built for the purpose of death benefit. And somebody says, "Hey, can I get a death benefit of 500,000 in whole life? How much does it cost me?" Now, if you pay just that amount, just the amount that the whole life costs, yes, in year one, at least, there will be very little cash. Although there will still be in some cash, at least in the policies I'm working with, there will still be some cash. It will not be zero. But in a lot of policies, it may be zero in that first year because it's the full cost of the coverage. So you're paying for the life insurance and it's the cost of the coverage. So there's no available cash for you to use in a quote regular style policy, I would call it. However, when you're building a whole life policy for the purposes of using it as your banking system, infinite banking style, then you will have cash in the first year. And depending on the structure, it could be anywhere from 40 to 80% that you could have access to. This obviously depends on the structure of your policy when we're building it for your needs and your premium goals and what you can fund and how you're going to fund going forward. It depends on a lot of things, but you certainly will have access to cash if we are building it for infinite banking, even in year one. Year one will take the biggest hit. You won't have access to all of your dollars that you put in because there is still the cost of the insurance. But when we're building a policy for the purposes of infinite banking, we are shrinking down the death benefit on purpose because if the death benefit is lower, so are your costs. So then the premium that you fund over and above the cost of the death benefit go right into the account that you can access. And so in the first year, you don't have access to 100% of your premium, but years 2, 3, 4, and beyond, it starts to build up to a point where you do have access to 100% of the premium you just paid in. And then beyond that, once it becomes cash flowing, which depends on your age, depends on how you're funding, depends on how the policy is structured. But once it hits a point where it's cash flowing, it will never look back. And every premium that you send in will yield you a higher growth inside of your cash value that you have access to, income tax free. So Dave goes on to say that you can't even access your full cash account before you die. If you try to access that cash, you can't access it, and that you can't access it until your cash value until maturity of the policy, which is 100 or 121. And that, of course, is straight up false once again. Not true. You can access your cash. That's the whole thing we're talking about here. That's the whole exciting thing about infinite banking. Of course, you can access your cash. And he does mention the surrender value being an issue, which that is only associated with universal life contracts. So with your whole life contract, you're not going to have surrender charges or surrender value. Surrender charges on universal life contracts can last anywhere from 10 to 20-ish years. It can be long. And that just means even though your cash account might say 20,000 or something like that, in the first year, you may have access to 1,000 of it if you were to cash out your account. As the years go by, you do have access to more and more of that cash inside of a universal life policy. In the beginning years, though, it's pretty low if you were to surrender the contract or even if you were to borrow against it, unless you add other certain riders to be able to give you access to the cash, which I'm not sure how those riders work or how if every company has a rider like that. I do know of companies that do have that. I don't know about all of them. But yeah, he may have been referring to the surrender charges on those contracts because whole life you have access to whatever is available in your cash account. And that value will be growing. So he talks about being able to access your cost basis tax-free in your whole life policy or your permanent contract. But then he goes on to talk about loans in a really negative way. He says things like, well, of course you have to pay your loan back. You can access your cost basis, but then you have to take loans or you're going to have to use loans to access more of your money. And of course you have to pay it back. When actually, when it comes time to taking money from your policy in your retirement years, no, we're not really expecting you to have to pay the loans back. Some people will keep it going, keep premium going, continue to pay them back. But there is an option where you do not. You do not have to pay those loans back. We are factoring all of that in so that you can simply be taking income from the policy on a tax-free basis. And yes, that's why we're using loans in that time frame or in your retirement years, because that's not taxable when you take money out in that way. But we're taking it out in a way and planning it out so that you're not expected to pay it back by the time you're age 95. No, that's not how it works. So when Dave is talking about how there's no cash value in the first 3 years, he goes on to talk about the lousy returns and refers to it being a lousy investment. Well, we already know it's not an investment. It is an asset. So he's not even speaking about it correctly. So if he wants to compare rates of return with the other investments, he should be going to the investment world because this is not an investment. This is an asset. Whole life is the place you go to put your cash, your savings, to build and protect your warehouse of wealth from which you can then go and use the funds to invest in something else that you're passionate about to go chase those returns if you want to. But the funny thing is that even though this is not a vehicle to seek crazy high returns, because this is just our warehouse where we're storing our wealth, that's going to be earning for us for the rest of our lives and capturing the earning power and dividends and doing a lot more for us. By treating yourself like a banker and housing your wealth in whole life policies and then bank with them, the growth of your money and your wealth can easily smoke those returns you're seeking from other vehicles. Because taking over the banking function in your life is one of the most powerful things you can do to grow your wealth. So, another thing that Dave likes to talk about or mentions something he doesn't like about whole life is that the life company absorbs the cash value of your life policies while survivors receive the leftovers in what's called the death benefit. Leftovers? I don't think so. Let me give you an example. If you funded roughly, let's say, over your lifetime, $1 million into a whole life policy by your age 86, so we're in our really old years now, and at that age 86, you have nearly $3.5 million in cash value available. But you didn't use it. You left it there and you passed away. You left your $3.5 million in the policy. And then when you die, your survivors end up with $4.3 million. Is that a lose-lose situation? I don't think so. Not in my book. Ramsey's saying that they are keeping your cash value, when really what it seems like to me is they are giving your survivors all of your cash value and then an additional $800,000. Or you could look at it as, I have $3.5 million and I passed away and I'm going to go ahead and trade this $3.5 million so that you'll give my family $4.3 million instead of the $3.5 million that I had. Either way, it's more money. It's more money than what you had, and they're going to be getting more than what you have in cash value. In this example I just gave, I was giving an example at age 86. In this same example, if you look at age 85, it was more like 1.3 million higher in death benefit than what was in cash. So the family would be getting all the cash value plus $1.3 million more than what they had in cash value to give over to the family. So for me, being able to have the opportunity to trade my $3.5 million to leave my family with $4.3 million, oh yeah, I would take that all day. And of course, if you were to die with a loan balance, it will be deducted. This might be one thing that's talked up a bit with universal life products because you can structure it in such a way where you can tell the software, at the death of the client, I want both the death benefit and the cash value to go to the survivors. However, if you have a good agent and they are looking out for your best interest, normally they would change that selection over from cash value plus death benefit to death benefit only once you reach an age, a retirement age, maybe around 65, because in order to continue for your beneficiaries to receive both the death benefit and the cash value, you're more at risk. The company is more at risk for a higher death benefit for a longer time period, which just causes the cost of your death benefit to be higher. And then your cost inside your policy will be growing even if you're not increasing your premium payment. So that extra cost will be coming out of your cash value and dwindling that down. So if you have a good agent, most likely they are going to do something like that so that at age 65, roughly, maybe 67 or 70, they switch it over. So now it is death benefit only. So if you have $300,000 in your cash value and your death benefit is $500,000, you will no longer receive the $800,000 once you get to those older years, but just the $500,000 death benefit. So because the risk is lowering for the insurance company, that keeps the cost of insurance down, because if you have a $300,000 cash value and now you have a $500,000 death benefit, the only risk for the company is $200,000 instead of a full $500,000. So normally that is a switch that is made right around the retirement years in order to keep the cost of insurance lower, so it doesn't eat away all of your cash value. But now, Dave Ramsey says just by term and invest the difference. So what kind of death benefit do you leave your beneficiary with a term policy in your older years? Well, usually nothing, because the older you get, you're not able to acquire term insurance or for very many years. And so when you're in your much older years, oftentimes you no longer have that coverage. And when you want to buy a policy in your 60s and 70s, it's certainly going to be more costly. So as an example, for a 66-year-old, I just happened to be looking at this recently, who wanted a 20-year contract in average health for a term amount of coverage for $500,000, it was going to be $818 per month. So after 20 years, that would have cost $196,000, a little over that. And so that's how much they paid to be covered for 20 years at $818 per month. And then how much of that money do they have access to in that time period? How much of that cash value can they touch? Zero. None of it. So they've just spent just shy of $200,000 to be covered, which again is still better than nothing if you want to have that coverage in your older years and you don't have a whole life or you can't get one. Maybe you already have a term in place and you're no longer insurable. So it's still better than nothing if you can't get a whole life policy, but you can see how you're going to spend a lot of money. At age 70, you can't even get a 20-year policy anymore. It would be 15 years. And so, or maybe age 71, you can only get a 15-year policy. And for an average health rating, that's looking like $1,155 per month. That's over $200,000, $207,000 that you would have spent in those 15 years to cover at $500,000 death benefit for your family. So in that scenario, there's no cash value. You're just renting the coverage, and the life insurance company is only renting it to you because they certainly don't expect you to die in that time period, or they wouldn't have given you the coverage. Term life insurance tends to pay out about 1% of the time, so not very often. Term insurance is really the cash cow for the life insurance company because that's people renting coverage. They don't pay out claims that often, and they just get to keep all that cash. So one more thing that Dave likes to talk about when he's talking about whole life is the high fees in whole life contracts. But again, with a better structure such that an IBC practitioner can build for you, you will have more of your cash available sooner and your policy will become cash flowing. Because when we're building these policies, we're shrinking the death benefit, which shrinks the cost. So we're building these policies with cash growth efficiency, your cash value to grow efficiently as the goal, as opposed to a high death benefit. So if we're referring to the example I just went over about paying $1 million into the contract and having that amount of cash value at age 86, the $3.5 million, and access to it on a tax-free basis, I don't care what my fees were, to be quite honest. My account was guaranteed to grow, accessible all my life without penalty, accessible income tax-free. It gave me additional benefits all throughout my life. It gave me control of my capital to give me more power over my financial life and financial freedom. And then I will end up leaving behind a legacy to my loved ones or my favorite charities. So I'm giving high age. It was age 86 was my example, but still at a younger age, it's still a good amount of money. I'm just trying to give an example of when the person was older, how much death benefit are they leaving behind? It depends on how much you funded and when you start, how much you're going to have access to, but it's certainly going to be worth the fees that were paid. And what product is there out there that doesn't have a fee? Someone tell me. I mean, of course, there's fees with literally everything. At least with this, you have guarantees on your side and a lot of benefits, living benefits on your side. So basically, Dave really needs to just stop talking about whole life is what I think. He needs to stop talking about what he doesn't know about. And why would he have such in-depth knowledge about this stuff anyway? It's not like he has any licensing. He's not a licensed life insurance agent or a licensed financial advisor. Instead, he's an author and a radio personality. And with all of the years he spent talking down whole life, it's a root of what he talks about. It's one of the bases from which he believes and which he talks about in his books and online. So with him talking it down and selling books about this, with this perspective, I would hardly expect him to actually take a deep dive and learn this product well and understand why we are trying to scream from the rooftops how amazing it is. Because then he would have to backtrack on everything he's been saying for years and years and apologize. I really don't think that's something he wants to do. So that's all I have for you today. Just my ranting and raving about Dave Ramsey. I probably could do an hour podcast on this topic. Just keep going and going. He's so frustrating. But again, there is some good in what he's teaching out there. Well, in any event, if you'd like to connect and talk about how an IBC policy could work for you and your family, if you'd like to work together, please reach out. You can reach me at Valerie@alphaomegawealth.com. And I would love to connect with you. I would love to look over your personal situation, your scenario, your financial scenario, and help you think through what would be the best for you and your family. So thank you again for listening into the podcast. I hope you have a great week. Until next time.
This is thepodcastfactory.com.